on board Sameer Dalal as well and figure out what is it that he's recommending in this market. Sameer, hi, morning. Good to have you on the show. A big rebound in crude. Of course, it's debatable whether it's sustainable or not. But what should the strategy be in the market right now? Would you say we're not out of the woods just yet?
No, good morning, Aisha. First of all, thank you for having me on the show. And yes, we are absolutely not out of the woods at the moment. Let's put it on today. What you all were just discussing. 20% of the global crude passes through Hormuz, and if that situation does not ease, crude prices they've come off temporarily, yes, but eventually they will keep moving upwards, and that for India is very bad, right? Um, we've discussed this on your channel before also that today, if crude prices move up, there are two things that happen. One is either the government has to take a hit because they don't increase the prices to the end consumer, which means that they either cut their excise or they tell the oil marketing companies to take a hit on their margins and or profitability. Or the second is the fisc gets badly affected because the government takes the hit and they need that money which they get from the collection of the oil to manage their fiscal deficit. So it's a question of which way it goes and how long this continues. Till we have clarity on when this ends, what kind of end does it have, how much damage is created to oil assets all over the Middle East. See, Iran is not a country that's going to go down without too much of a fight. I don't think so, at least from what we've seen so far. And what stops them from hitting oil assets all over the Middle East just to create global chaos before they go? I mean, when you have your back up against the wall, you'll take any step necessary. So for me, in this kind of situation, to say go out that everything is sorted, problems are over, it's all in the price, I think it's a difficult thing to say. The markets run on three things, right? The fundamentals, sentiment, and liquidity. So for me, fundamentals may get better if things ease up, but the sentiment has definitely been hit. And two, I'm more worried that the liquidity will get hit because what's happening with the FI outflow and Indian mutual funds buying, kind of to support the market, they may soon run out of money. And if mutual fund investors see that there's no returns happening over a 2-year period and they start pulling, then where does it leave us?
No, absolutely, Sameer. If I were to kind of get a sense of how you're playing this market, so obviously you're suggesting that it's clearly not a buy at this point. But if one were to buy something in this market, Sameer, what is it that you have currently comfort in, or do you absolutely stay away? You stay on the cash that you're sitting on?
Okay, so I'm not saying that you don't go out and buy. Yes, my view is a little pessimistic and negative at this point of time, and because of the global situation. But am I saying that no, there are no opportunities to buy? I'm saying buy, but buy in small lots. So say you have 100 rupees to deploy at this point of time, maybe start with 10 bucks or 15 rupees as an investment, right? Don't go all out saying, look, the market is down. I'm happier buying 3% or 4% higher as long as I know there's certainty and I can actually predict what's going to happen. I'm not predict, but be more certain of the outcome rather than uh, uh, rely on hope, right? So that is the point. Now, what I would buy, so banking and financial services, I remain very positive. Now, one of the stocks that we did buy yesterday also, I will say, is HDFC Bank. The way I look at it is, look, you're getting this stock which has come off from 1,000 bucks from the highs to about 830, 840. Even if at the end of a year and a half, it's back to the 1,000, that's 200 rupees, 220. I mean, if it's up 200 rupees on 800 rupees, that's a 20-25% return, which is fantastic. And you're getting that from a blue chip in India, which is India's bellwether. So that is something, stocks like that is something you can invest in. I think now with IT having coming off as much as it has, the div yields are going to be good. You could probably get 3 to 4% upside on IT stocks. I'm not saying they're all out buys. I'm saying they're great from a point of low risk, good 10, 11% return kind of stocks. So that is something you could probably look at. And this oil price surge is definitely a wake up call for India and the Indian government to say that, look, we need to be more dependent on ourselves. And if we can move more towards renewable energies, which can fuel our cars, make a push for electrification of vehicles more aggressively, which reduces our dependence on oil. That is something, a theme that could probably play out. And I believe the green energy push probably could get more of more of tailwinds kind of situation. So focus more on that space. I mean, there are individual stocks you have to look at and you have to study whether that fits your bill. But I mean, those are the kind of sectors and stocks I would look at.
You say that, and let me pick up on some of those themes with Kunal. Kunal, firstly, on the charts of HDFC Bank, I mean, one can't have it all. So within banks, you've always talked about as to how PSBs are looking much better poised. Would you bet on an ICICI Bank or an HDFC Bank, or say that restrict yourself to PSBs because they have a stronger chance of a better uptick?
Yeah, I think I'll go with the latter as of now. PSU banks is something which I would continue to bet on, and especially the larger cap names like SBI, which has proven its mettle over the last 6 months or so, and especially over the last 2-3 years. Also, I think we're at the point where HDFC Bank and ICICI Bank have been more flattish. So price-wise, yes, HDFC Bank and ICICI Bank, they would start to look a little bit more attractive. But the only missing part over the years is the zing or momentum for these names and lack of participation for these stocks on the upside. Whether that happens very immediately, whether that triggers into FIIs buying back again or coming back to that buying spree, all of those are imponderable. So it's difficult to try and guesstimate when would that cycle turn for many of these private sector banking names. I'll wait for that to show signs of emerging in the charts for these private sector banking stocks and then take a bet. But as of now, I would still go with the proven names and the ones which have performed very well for themselves in the last 6 months or so.
And what about IT? Is that poised for a more sustainable bout of short covering?
So that selling is over for the IT stocks. Short covering has not yet happened for these IT names. I don't see that immediately happening. Generally, we've seen short covering either coming back on a positive news flow for stocks or sectors, or it starts off by the end of the expiry cycle or a start of a fresh expiry. So there is a strong possibility that IT stocks, they can just about linger at these levels what they have traded. It's a 25% cut for the IT index in the month of February approximately. So I think in that context, to try and scale past maybe a 10% could require some bit of positive news flow. As of now, there's nothing on the anvil for many of these IT stocks, and that's one of the reasons why you're not seeing a very gung-ho kind of a price up move for these names. One-off days you've seen Infosys rallying up, the other days you've seen Persistent showing signs of 2%, 3% pickup, but it's not meaningful or neither in context of a new trend which is emerging.
Sameer, how do you look at IT? We've seen the index down, losing nearly a third of its market cap. There is a derating that has happened. Do you think the derating exercise is over for the IT, and stocks which were trading at 22, 24 times now are trading at 15 to 18 times, and that's a new normal for them?
So is this the new normal for them? I think rightfully so, yes. This 15 to 18 times is going to be the new normal for IT, because when companies are growing at 5 to 6% on top line and maybe 7, 8% on bottom line, when you trade at, say, 18 times earnings, you're trading at about 2 times PEG, which is a fair PEG to give any company, right? So is this the new norm? Yes. Now, if you just, I mean, I just step back to what I said earlier. So IT is something I'm looking at from a very different kind of an investment perspective. I'm not looking at it as something that's going to give me a 15% CAGR return over maybe the next 3 years. But I'm looking more from a 10% CAGR, kind of 11, 12% CAGR returns with low downside risk. So if I look at the risk reward, I'm not going to get the high returns, but I'm going to get 5 to 6% dividend yield because these are very high cash generating companies. If I'm talking of that, say 5% or 6% cash yield, and the stock top line growth is at 5% or 6%, and I get that kind of growth also in the stock price. So I'm talking of in CAGR returns, say 5%, 6% plus 5% dividend yield. We walk away with a 12% return CAGR on these stocks with low risk, right? Because these are debt-free, high cash generating, good ROEs, good. So, for me, the way to play IT at the moment is low risk, decent returns. I won't say these are equity returns, but you could make returns, like I said. So invest from it from kind of like a debt kind of a perspective rather than an equity kind of perspective. And I think that's where you'll find the value in IT. Growth will be selective on some stocks. So some of the smaller companies who are working more on the AI side or working more towards different kind differentiation of product, like sometimes what Persistent does, or something like KPIT Technologies or a Tata Technologies does, which is more for auto sector, where the growth could accelerate a little faster, those may continue to trade at slightly higher valuation premiums and could give you the higher returns. So you can't paint everything with a single brush. But the larger IT companies, which we just discussed, like TCS, Infosys, Wipro, HCL Tech, Tech Mahindra, I think we should accept the fact that 10 to 12% growth is the new norm on the return side of expectation for IT.
Samir, do you expect the street to look at dividend yields at this point in time, given the fact that many the investors want companies to invest for the future growth, and especially with respect to AI or any other new technologies they are working on or products they are working on, and giving back cash to the investors or through a buyback would be seen as a negative one at this point in time?
So you don't have to do either or, you can do a combination of both, right? You can continue to pay back some amount of money in the form of dividends to your investors, and you can still invest in IT and future technologies. So, what is the real big investment that you're making when it comes to in AI? It is more of the data centers, right? So, you don't need to per se plow all the money in, given the fact that the government, we've discussed this, I think I've discussed this with you all as well. Given that the fact that the government has given this tax holiday for data centers in India, it could be very well put that these companies like TCS and maybe some of the others that are setting up these data centers only own 20 or 25% of the data centers. So their investment gets kind of limited. And the rest can be investments that come from overseas for those data centers. So you have all of that in place. You are operating it, you're charging a stream of revenue to it, and you're getting some amount of investments made in that space, which is required. But you also don't have to put in so much money that you kind of hitting your balance sheet so hard or hitting your cash flow so hard. Plus, you're able to pay out the dividend. Coming to the LLM models, I don't think um, we are kind of late to the game when it comes to the modeling and all of that. So we are going to have to rely more on integrating of those models in India and work alongside some of the larger players that are there in the US and maybe even through China, and work on that. So investments there are not going to be that significant. Yeah, could we look at some acquisitions from the larger companies? Maybe, but some of the smaller companies are, if they kind of go out all out and start putting in all of this modeling and LLMs and data centers, then obviously it hurts their balance sheet significantly and then opens up a whole new avenue of risk if something was to go wrong. So I don't think any of these IT companies are going to make such large investments and risk their balance sheet at this point of time.
Okay, you know what we'll do
is very, very quickly and try and claw back about those levels. But I think that's a deep process which could be something to watch out for. As of now, I would look at a meager short covering rally, maybe a 5% to at best 10% on the upside over the near term is what I would expect.
Okay, that's that on metals. The other space which was really beaten down yesterday was the entire auto pack. Sameer, do you think the recent bout of decline is a good opportunity to add on to existing auto positions? You know, your Eicher, Maruti, as well as M&M?
So be selective in that, right? So M&M is something that, yes, we do like. We think there is an opportunity because it's not only auto, it's more of the domestic India facing kind of business, which does tractors as well. So that is something we do like. Maruti also is domestic facing, no doubt, but there is some amount of exports, which I don't think is going to get affected that significantly because it doesn't send too much to the Middle East. It's more towards the African nations. So that should not be a problem. But valuations there we find a little exaggerated or higher. So from the valuation discomfort, I think Maruti is something that we have chosen to avoid at this point. Mahindra is something that we do like. Now, just to put it simply, yes, we do think the auto sector is something to invest in from a longer term perspective. Tata Motors, but PV is one of the stocks that we also like a lot, and we think there's a great opportunity, valuation comfort, given the fact that we've had this huge fall after the problem that Jaguar Land Rover had in Q2 and Q3, which is now behind and which we think will come back. But like I said, our valuation is going to run up immediately. No, they're not. The sentiment on the market has been hit. So what we expect is valuation stagnation for a while. And once things get clearer, the picture maybe 3 months, 6 months down, like gets better, I think that will be an upside. So be selective, buy slowly, don't be in a rush to buy, because the market could go a lot lower before it goes up. Because if this situation globally does increase, it is a problem. And what I want to emphasize on your channel and let people, what my thought process is when FIs are kind of selling the way they are, it's not possible for markets to keep going up. So don't expect a quick bounce back. And why are the FI selling is more important. If you pick up stocks from the Nifty 50 and you look at it over a period of 7 years, you will see 90% of them have given negative returns in dollar terms. And which is why we are seeing this exodus of FIs. Because even though the stocks may be up 10, 15, 20%, when the rupee is down 25% over the last 7, 8 years, it hurts their returns. Now, imagine getting no returns over 7 years, where you could have earned maybe a 4% just by putting the money in the US debt. So that till that situation changes, till the rupee starts stabilizing, till we think that Indian markets valuations don't come to very reasonable levels, I don't see FIs coming back in a great rush. And for me, for that reason, markets are not going to do very well in the short term.
Okay, Sameer, I'll come straight back to you in just a minute. Kunal, let me come to you. You know, you called this out. You said that the bounce back that we saw in markets from the 24,500 levels, you said that we will test 24,300 one more time. We not just tested that, we tested 24K and we've held up now. Talk to us about where that puts us from a technical standpoint at this juncture. Do you believe that this is the right point to buy and to buy big? Or, like Sameer is saying, you hold on, there could be lower levels that we could test. What could those levels be? And what would you be eyeing out for?
It's very difficult to say that, because given the context of the geopolitical news flow which keeps on changing daily, it's very difficult to anticipate that whether that news flow will abate. But if I look at it or stick to it on a statistical perspective or on the technical fronts, what happened yesterday was one of the indicators which we track in terms of the market breadth that for the first time came back into a deep oversold territory. The last time, I think, when we were at the deep oversold territory was in March, April 2025, when we were almost at 22,000 levels or thereabouts for the indices. Yes, that was again a panic scenario for the indices, where you'd seen a sharp correction, but that led to a major bottom in place. Now, the only catch over here is the news flow which is surrounding. So, if the news flow, assumably, I think doesn't deteriorate further, then strong chance that we may not just see a bounce back of sorts, but you could probably expect that the index could kickstart a decent uptrend for itself. So indicators are into a deep oversold territory at current levels of 24,000 where we closed yesterday. There is a divergence which has been formed. So divergence is generally considered to be very bullish because when prices make new lows, but indicators, they make apparently a higher low. That's an indication that the indicators have stopped falling, and it's a first sign where the prices could go into a recovery phase. And many a times these recoveries could come back into trending mode. The other good part is that we were erstwhile dependent on PSU banking names, metal stocks, which were the two best sectors. Now you have the third sector which is emerging, that's the pharma pack, which has been doing very well for itself. Then there are many other pharma stocks which are now looking attractive in the context of trying to reboot their entire cycle, which has been on the downside. So I would probably assume that with new sectors adding up, defense names which have done reasonably well, there could be a point where this cycle also could turn. So with more sectors adding up, it adds to the confidence and the possibility of an uptrend.
Right. So at least that's the play. But close eye on the news flow. I think that's what that's my key takeaway from everything that Kunal said. Yes, it's deeply oversold, but you want to keep your eye on the news flow. Sameer, if I can come to you with regard to real estate. Now, this one hasn't done anything since December of 2023. So we've now seen 2 years and a few months where the index has done nothing. And it's a high beta index as well. And therefore, you could see really chunky returns. I'm trying to understand what's caused the kind of moves on the realty index, if you have the kind of a perspective or a view on that one. And also, if you were to buy, what would those players be, specific players within that pack be?
Yeah, so you're absolutely right. Real estate hasn't given much returns. I think the returns have been more subdued over the last 6 months. So if you go back a little bit, I think the stocks had all run up quite significantly before that, and valuations had moved to very, very high levels. I think Godrej Properties moved up from 1,200 to 3,600. Prestige Estates probably went from 600 to 1,800. Oberoi Reality from 800 to 1,800 or 2,000. So you saw the run-ups that happened. And this was on the back of the constant news flow of the kind of sales that were happening across the board, right? Projects were getting sold out within days of being launched, which was a very, very big positive. And look, whenever things news like this happens and stocks start moving, you get the momentum, you kind of people get carried away, and then what happens is you get overvaluation. So I think we went to a bit of overvaluation, but you got to remember that these projects were sold out, which means that they're being built right now. So the profitability of that is going to come. And these stocks have corrected significantly, like you rightfully said. So Godrej Properties is one of the stocks that we are positive on and are long on. And the stock has corrected from 3,600, I think, all the way down to 1,600. So you're talking of a 65% correction. So once the profitability from all those projects that they pre-sold start coming through over the next, say, 6 months, we think you will see a rebound in that space that comes. So we think sales will obviously continue. Momentum may slow down a bit, but positivity remains. The three stocks that we in the real estate space are long on, one we already mentioned to you is Godrej Properties. The other one is Embassy Developers. The stock, we've taken a position in it recently because the stock has seen a huge fall after the 300 crore order came. I mean, they basically have to pay Canara Bank 300 crores for certain backstops that were there maybe 11, 12 years ago, which is obviously being fought in court. But 300 crores, even if they pay, is not the end of the world. So we think there's an opportunity. The stock has been massively oversold. And the third is Keystone Realities, which is a Mumbai-based player who's doing a lot of redevelopment. We think there's a lot of opportunity, and the stock is quite attractively priced there. So those are the three that we are positive on. And we think the real estate space will continue to do well over a period of time because India still needs a huge amount of housing. There's a huge potential for growth. So we remain constructive, but yes, you're right. The stocks have massively underperformed over the last, say, 6-8 months.
Okay, the other theme that's playing out, and Sameer, I'll urge you to stay on, is this entire theme around consumer durables. And LG had its roadshow. Here's the key takeaways from the roadshow. Snehi here with that.
Well, yes, so Morgan Stanley has come out with a note on LG Electronics. They've recently held a roadshow, and Morgan Stanley has a price target of 1,726 rupees per share, which is almost a 13% upside, 12.8% upside to be very precise from yesterday's closing price for LG Electronics, and they maintain their overweight rating on the stock. Now, here's what they have to say. They believe that in terms of Q4 demand, AC demand is picking up in the north and west of India